What do you think the headwind is here for global GDP and potentially corporate earnings?
Sure, Tyler. So, we have to recognize first and foremost that you could basically drive a truck between the upside and downside case scenarios here, because nobody has a very good beat on how long this is going to last per region and how governments, corporations, or individuals are going to react. Now, having said that, if fair heads prevail through this pattern and we try to minimize damage while also trying to deal with the disease in ways that we've dealt with other outbreaks in the past, we should experience somewhere around a 0.5% to 1% headwind to global GDP growth. And that's based on assuming that China took its hit, and that is what it is, and it has to pass through the system. And everybody else that's affected takes a smaller but still notable hit along the way in trying to rectify the situation and slow the spread of the disease. That is part of what the markets are reflecting. I would argue that markets may be over-reflecting a bigger chance of bigger downside at this point in time, but time will tell on that as we process along through this.
Tim, do those numbers sound in the ballpark to you? A little too modest? A little too grave? What do you think?
No, I think for first quarter GDP, if you look to the main economists on the street, where people have cut down. UBS is down to 0.06. You've seen people cut it to the bone. Bruce Kasman at J.P. Morgan, I think, is pretty much right down the middle at 1.2. The bottom line here is we had risks to global growth before the coronavirus. So if you think about Europe's economy, think about the biggest economy in Europe, which is GDP, and the export route into China, what was happening with the trade war. PMIs around the world throughout the fall were essentially caving, and then we were wondering where we were starting to see a little bit of a bottom. We were. The dynamic here isn't great, and I think that's what equities should be grappling with, because if you think about where we were on those lows of October 3rd, before the markets then went up 19%, a lot of that was Fed liquidity, and I think markets would have been grappling with the same things we're grappling with now with the coronavirus.
And Jason, in terms of liquidity, let me just go back to the question about whether providing more liquidity, acting as the lender of last resort, lowering the rate. Are all of these things, you think, fundamentally going to help the U.S. economy, or do they risk doing more harm than good?
So number one is, I'd say there's two problems to fix. One, which the Fed and liquidity has no solution to whatsoever, and that's the actual outbreak of the disease and any ramifications that come from that, and any shutdowns that governments have to do regionally and otherwise. The economic impact of that is going to be what it is, number one. But number two, what they're trying to avoid is a seizure of financial markets and credit markets that could be a second-order impact here. With the central bank stepping in, they try to avoid that situation and try to keep this from spiraling to the downside out of control and having kind of second-order knock-on effects that take this down further. Long-term impact, look, low rates, ongoing fiscal and monetary stimulus. Eventually, we have to get out of that trap at some point in time. We need it right now at this instant. What they need to do is, once things get back online, they have to take that away at a reasonably fair pace in order to get us back to normal operation down the road. It's just, we're not near that right now.